I was here 2 years ago, and I think the market was a little different. And so a number of you said, well, why are you even speaking today? We all can read the newspapers when we just have lunch. And in fact, maybe the reason we have such a big crowd is so everyone could have a free lunch. And it isn't really the topic, because I think the topic is just so exhaustively discussed in the newspapers that it's sometimes hard to articulate some different perspective. But hopefully we're going to be able to present to you what it's like a little bit more in the trenches. Yes? No. Hello? Let me turn on. One. Hello? Okay. The first question is, what is a bubble? And I think Alan Greenspan probably says it best, and that is, when you're in the middle of a bubble, you probably just don't know it. And in fact, in the back, you'll see a paper that we published in '04 that talked about what would happen if a real estate bubble formed. And the Federal Reserve at that time swore up and down that there was no bubble forming and that we all didn't have to worry, even though at that time it was obvious that incomes were not going to keep pace with the appreciation that we were seeing in the real estate market. So what caused this bubble in the first place? Well, generally bubbles go from one bubble to another bubble, and in between those bubbles there are usually bursts. So the first bubble that we had was the tech bubble in the stock market back in the late 1990s, early 2000. And as interest rates fell and people started to get involved with what the Fed called unrealistic exuberance, that what happened is that people ultimately overinvested in the stock market, interest rates fell, people lost confidence in the stock market, and subsequently decided that real estate was a better place to put their money. And so quickly prices started to escalate and appreciate, primarily because of investors and speculators, and because banks were funding a type of addiction. And the government itself, particularly this administration, was very, very bullish on making sure that individuals were going to own their own homes. In fact, 70% of all homeowners, or citizens of the United States, or families, own their own homes, which is a record. But the only way the government could do that was to allow a new product, a new type of lending to occur, which is now euphemistically called the subprime market. And that market just continued to grow and blossom as this real estate bubble started to form. And the subprime market now basically is also in collapse. And of course it fell and collapsed in part because the real estate market collapsed. But the two are somewhat in tandem. In fact, they're predicting that probably 35% of all subprime mortgages will ultimately go into foreclosure. The subprime market was a critical market because it's a trickle down or trickle up effect. The folks who were borrowing from the subprime market typically were buying at the lower end of the market, and they were allowing people in middle class homes to move up to the next level and to the next level. And ultimately, the folks who were buying your new homes and your more expensive homes, those folks were able to sell their homes because of a chain reaction, a conveyor belt that was actually allowed to occur. Now that conveyor belt has stopped for a while, and it's going to be quite some time till that conveyor belt gets going again. Do I really need to do I really need the mic? Let me try without it. Okay, I'm going to move in. Okay. The Fed says that it's going to probably be about 5 years for the bubble cycle to completely work its way through. That means that if you look at the top of the market, and there's some graphs that you all can look at later or now that reflect, in fact, that from the top of the market to the point that we get back to a point where prices are either continuing to go up again, could be 5 years, and it could be as much as 7 years to the point in time where we reach the same prices that we had at the top of the market. And by the way, the top of the market, most experts believe, was sometime in October 2005. Now, what's interesting about October 2005 is that was when Katrina hit the United States. And it just didn't hit New Orleans. It hit all of us. It hit all of us in many different ways. It hit all of us in the sense that we saw what a natural or man-made disaster could happen anywhere in the United States. And the devastating images of bodies floating down the street knocked, I think, us off our stride psychologically. And people stopped. They were watching CNN. They couldn't believe, how could this happen in the United States? And more importantly, it said to people, what happens if this happens in Florida? What happens if there is a terrorist attack in New York? What is going to be the national response and the ability of this country to react to that kind of calamity? And the answer today is still not clear what's going to happen, because it is still not clear if New Orleans will really fully ever be recovered. Some people have described that our response and recovery in New Orleans has been worse than our response and recovery after Hiroshima. And there are entire areas that I haven't personally seen, but I've seen images and pictures, that would suggest that it just looks like a bomb went off there last week. And there are just acres and acres of land that needs to be reclaimed. It just hasn't occurred. So if hurricanes do get worse here in Florida, and we had something that came close to it, investors, speculators, and folks who used to come and move down to Florida are asking themselves, is this a kind of risk that I want to accept? Now, when I spoke 2 years ago, 1,100 people a day were moving to Florida. Today, at most 500 people are moving into the state, and that doesn't include the folks who are dying, and it doesn't include the folks who are what we call halfbacks, folks who are moving to North Carolina, folks who are moving to Tennessee, folks who are moving to Georgia, because they've had enough. And what have they had enough of here? They've had enough of issues concerning taxes, and they've had enough of issues concerning insurance, and they've had enough of issues concerning, I think, educational services to the community. And the tax issue the insurance issue may be getting better. If we actually do not have a major hurricane this year, I think we saw in the paper State Farm is rolling back their insurance rates by 9%. And I think the insurance companies will be flush with more cash, and they're not going to be able to continue to increase their charges to their homeowners. But the question is taxes. And it's unclear what's going to happen with this tax bill, the constitutional amendment. But whatever it is, it's not going to be substantial enough. And it's going to continue to hurt folks who want to move to Florida, because you have basically a two-tiered system. You have two classes of citizens. You have those that are entitled with their homes through homestead, that have been in their homes and have this vested tax interest that they've held for years. And then you have new folks who are moving down who could live across the street from you, and their tax bill could be 2 or 3 times as much. So it's kind of like rent control. And growing up in New York City, I can tell you rent control is good if you own a rent-controlled apartment, but if you're a new person coming into the city, it was terrible. And of course, we were one of the people who lived in the city and had a wonderful rent-controlled apartment. But the fact is, it's very bad for that economy. And what we have in Florida is a market that has basically stopped functioning. We have a real estate market that has stopped functioning. We have 41% less sales. We have anyone affiliated with the real estate industry, whether it's a mortgage company, a company that sells photocopiers, whether it's a title company, a real estate attorney, all these folks are hurting and having a tough time because they're part of what's called the real estate industrial complex. Now, according to the Federal Reserve, the real estate industrial complex equals approximately 20% of the gross domestic product of the United States. And that includes home equity and all the services evolving around real estate, which includes construction also. In Florida, most people think it's closer to 25%. So that means that every time prices go down, let's say 5% in the United States, 20% of that is, or let's say it goes down 4%, 5%, that would mean that 1 point off the gross domestic product will be knocked off in terms of the entire country because of that 5% decline. Now, what kind of declines are we looking at? Well, most of the experts are saying that we're looking on the retail side at probably a 20% decline in prices in most markets in Florida, but there will be exceptions. The Miami condo market is probably going to see a much greater reduction. Southwest Florida, a much larger reduction. Port St. Lucie, where things were just going bananas, a very large reduction also. Wholesale, and what is wholesale? Wholesale is what the builders are now doing to sell off their excess inventory. And you have hedge funds, vulture funds in Florida. Fortunately, we represent a few of them, so that's keeping us busy, where they are buying at 40% off the dollar. So that means that they're going to buy a finished